So let's begin. Number one, before we take it, we'll start analyzing liquidity, looking for liquidity. We have to ask ourselves, what is liquidity? Now, liquidity in the market is where uh, orders, people's orders are, where most people place their orders. And liquidity is where the money is in the market. So it is mostly where people, most traders stop losses are being put up. These are liquidities. And where do we see liquidity? We find liquidities at sessions highs and lows. For example, the New York session, the Asian session, the London session. Then the highs and the lows of this session are where we find liquidity. Also, you can find liquidity at weekly highs and weekly lows. Also, daily highs, daily lows, 4-hour highs, monthly highs, etc. So also you can find liquidity at double tops and double bottoms. Yes, highs and lows, double top, where you see equal highs or equal lows. These are places where you find liquidity. So what the market does is immediately before the market makes a push, it will first of all clear some liquidity. If the market is about to sell, it will clear all the liquidity above. It will take all the liquidities and the orders above buying. Then before it will now start targeting those liquidity below. That is when the market starts dropping. So that's what happens consistently in the market. You see it every day in the higher time frame and also in the lower time frame. These occurs in the higher time frame when you are looking for a good area, a point of interest in the higher time frame. You look for all this area of liquidity. You wait for price to come and take the liquidity. If you want to buy, make sure price has swept the liquidity, all those liquidity below. You make sure price has swept it and taking orders. That is when you go to down now the lower time frame and wait for the same thing. Price will also take the liquidity in the lower time frame. Then when you see price has started targeting the opposite liquidity, that is above, that is when you start looking for your buys. And what do? You take your entry in the lower time frame so that you get higher risk to reward. Then you target the higher time frame liquidity. So when you go in the higher time frame, what you concentrate mostly on is the liquidity. You mark your all where you know the liquidities are. Then when you go to the lower time frame, what you do is you look for entry, specifically in the lower time frame. It is the entry that you look for. So once you enter using the same method, you now target what the liquidity in the higher time frame. Because when you enter the trade in lower time frame and you target the liquidity in the lower time frame, your risk to reward will not be much. You will close your trade quickly. So but you are now holding the trade because you know that price will eventually target the liquidity will go there in the higher time frame. So now let's look at some examples in the chart now. Now this is Euro USD, the 1 hour time frame. Now I told you that we find liquidity at daily highs and lows and session highs and lows. So now, for example, you can see from all these vertical lines you see here, they represent 1 day. All this from here to this line here, this black dotted lines is 1 day. So when you go to daily candle, you see only one candle. So all this information from here to here is what we call it is one complete day. So now, when you come down here, this is an example from Euro USD on the 4th of December. On the 4th of December, you can see this example here. Now, here completely from here to this point here, we say it is what? A D. A D. So we put our now. This is complete D. This is the lowest point where price has reached on this day. Now you can see this is now what we call the liquidity. This is the lowest point of the day. That is where liquidity is located. That is where the money is located. So price will come down. Once price has taken all the orders below that day, that is when price will go and target the opposite liquidity, that is above. So now when you check again, you will now see here is the highest point on that day, that is 3rd of December, where price have reached. So now from here, you mark your high here. Now this here is your liquidity here. This is the highest point the price has reached on this day. You can mark these two highs like this, or you can just even mark it like this. Here, you see, this is the highest point price has reached that day. This is the highest point price has what? Reached. So you can see what happened here. Now, price came down here, price came down here, swept all the liquidities here. You can see there is a low here. This is a session low. There's liquidity. Price came down, swept it, and targeted this higher liquidity here also. So once price swept this one below here, it targeted the one above. So the next thing is there is another liquidity here. There is money staying here. So what did price do? Before it goes there, since there is no more momentum, you can see rejection here. So for price to reach here, it needs to come down and take some orders again. And that is why price came down here and sweep the liquidity staying here at the daily low here. So once price swept the liquidity completely, so now the volume and the orders, the price was able to target the liquidity above here on the day, that is the highest point the price is. So you can see this is what price do every day. This is what price do every day. Now price came down here, sweep it, then push aggressively. So these are areas where you want to be looking for your trade if you are trading liquidity. So now let's go down to our entry time frame. This is the 1 hour. So when you are using 1 hour to make your analysis, to mark your area of interest, you go down to the 5 minutes, then to look for your change in character and your entry, or the 1 minute. So now let's go back down to what? The 5 minutes now. Let's drag this here so that you see it clearly. Good. So now let's go down to what? The 5 minute time frame. Now on the 5 minute time frame, let's drag it. Good. So here is on the 5 minute time frame, you can see this was the previous day's low here we marked recently on the 1 hour time frame. So on the 3rd of December, this was the lowest point, and this was the highest point price reached. So what happened now? You can see from here, immediately price swept this point here. Immediately price swept this point. Immediately price swept this point. So you see, price swept all the liquidity here. So the next thing price, what it is what you can see. There is also a low here, and I told you from the beginning. You will note. I told you that liquidity are found in every area in the market. Previous low, old highs and old lows, daily highs and daily lows, session highs, session lows, etc. So now you can see this is a 5 minute time frame. This is what we call an old low, because this is now the most recent what low here. You can see lower highs and lower lows. So now what price, immediately price came here, it swept the liquidity. It could not, what price, it made what a lower high, came down again, swept this liquidity. This is what we call an internal range liquidity here on the 5 minute. On the 5 minute, this is an internal range liquidity. So immediately price sweep this liquidity here on the 5 minute. Then once you see price start targeting the opposite liquidity around this level here, once price start targeting this 5 minute liquidity here, you can see we can call that break of structure. You see, this is a high, so there is money there. So price is done targeting the ones below here. So now price has started targeting the opposite what? Liquidity. Sorry. Price has started targeting the opposite liquidity here. Now you see, immediately you see this high here. You can see price was just targeting the low. This is a high, this is a high, this is a high. So price was respecting this high. It could not clear the liquidities above here, but price was clearing all the liquidities below till price eventually took out this session liquidity. You can see here is a London session here. So there's money here. Price took out this liquidity, came back and took out the previous day's low. That is another liquidity here. So from saying this is where you position your entry here. Now you take note of this area. So what you do is, if price continue respecting, taking out all the liquidities below here, then you don't buy yet. So immediately you see price come and target this opposite liquidity here. You can see immediately you see this break of candle here. You see the body closed above. You can see this candle that broke it. The very aggressive and took out this high here, internal liquidity here. So now what happens? Price retrace back here to some area of interest. This is now, once you see this, you start looking for now your area, your confluence to take a trade. Now there are many confluences you use to take a trade. Number one, you can use supply. You can use imbalance here. If you want to know more on imbalance or fair value gap, then supply and demand. So I can make a video on that. So now you can see here, this is what we call bullish breaker. Once price make this lower high, sweep it, come back aggressively to take this high, it makes what we call a bullish breaker. Now this is what we call a bullish breaker here. Here, this candle here. So what happens? Now you mark it at a point of interest. So immediately price take out this high here. Now when price is coming back, these are your areas of interest, this box here. Because of, you see, there is a breaker block here. So when price comes here, you can take your buy here. Then apart from that again, there is also an imbalance here. You can see between this candle here and this candle here. You can see they did not meet. This is also another area you can put your trade here. So now here, from here again, this series of red candles again here, these are what we call the down close candle. This is also a powerful entry confluence also. You see, we've gotten three confluences again to take the trade. So now we've now seen price now sweeping the opposite liquidity here. Now to confirm that the price is about to reverse. Then the next thing is the timing. You can see this is around New York session when there is volume. So this is very important to check the time again. That is second complement. Third complement, we have the breaker block here. Then we have fair value gap, and we have what? A down close candle here. Can you see? We call this a down close candle. So from all these three areas, number one, your imbalance, number two, your breaker block, number two, down close candle. So once price comes down here and it starts rejecting, you can take your, you can put your limit order here and target the above. Where is the above here? This point here. You can target here as your take profit. You can see straight away price targeted the above degree before price started what coming down. So this is what happens every day in the market. So it is important to put your stop loss at the right, the lowest point here, because you know, for if price eventually comes here and take out this low, then your analysis is wrong. You call it a day or you wait for another word setup. So, but you can't put your stop loss below this kind of, do some traders do that, or below this breaker, but it can be lucky sometimes, but most of the time the market will get caught with you. So you have to be very, very careful. Put your stop loss in the right position. It is okay to experience drawdown in market, that is eventually, but you see in this scenario, there is nothing like drawdown. So once you see this aggressive red candle, you wait, you don't take your trade. This is what I do. I wait to see what the candles are also telling me, the final confluence. So once I see this rejection candle immediately when it closes, this is where I enter my trade. You place your trade here, and you put your stop loss here, and you take profit here. You can see from here down to this position. From here down to this position, this is almost around 1 to 2.5 or 1 to 3. So this is how to spot liquidity and to take your entry using liquidity. So if you have any question, please drop it in the comment section. Thank you very much. If you have been listening, you've been watching this video down to this moment, I appreciate it a lot. If you have any question on further breakdown, just please endeavor to write your comments and like this video so that YouTube will recommend it to others outside looking for what also knowledge on profitability in this industry. As I told you, my name is King Bash. I'm an experienced trader for over 4 years in this industry. So I think I'm in the right position to tell you some things about the market. So thank you so much, and we'll meet again. Peace out.